How can investors navigate this market volatility? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Katie Stockton, founder of Fairlead Strategies and portfolio manager of Fairlead Tactical Sector ETF. Hey, Katie, welcome to the
Hi,
show.
Maggie. It's good to be with you, even though it's a little bit of a distracting day.
Distracting day. What a week. I mean, what a week we've had. Just, you've been doing this for a long time. You've seen sort of market wobbles. Just put into context for me your reaction to the market.
It's interesting. So we obviously focus on technical analysis in our firm, and there is increased demand for technical analysis when the markets go down. It's kind of counterintuitive, but when volatility is running high like this, people go to the charts because they give them a little bit of peace of mind and help take some of the emotions, I think, out of what's happening. We can spend a lot of time understanding what, the market is reacting to. But we also want to understand how to position through it, how to navigate it, and, maybe what's next, right? None of us can predict exactly what's going to happen, but we can certainly put more probabilities in our favor, try to keep the momentum on our side. And all of the indicators that we use, they're based on price. So it's really math to us. And so we're able to be somewhat unemotional and largely unbiased when these things happen. What we tend to look for when you get these downward surges in the major indices are signs of downside exhaustion from both the overbought, oversold metrics that we track. That would be things like a stochastic oscillator or the DeMark indicators, which is somewhat more esoteric, but really very helpful. And then also we look for extremes in things like sentiment or breadth, which is market participation, extremes in volume and in leadership, meaning like new highs, new lows. And when we see those extremes, which is pretty rare, we really pay attention. So today was the first day that we saw an extreme in the market internals that really has us intrigued. And this is the VIX having risen above 45. It's not something that we often see.
Yeah. I mean, it certainly set my alarm bells off this morning when I saw that. And we are hoping to sort of give people something to use as they try to sift through the wreckage. Everyone's going to be contemplating things over the weekend. And you're right. The news is not going to stop, right? There's going to be a microphone and someone in front of it all weekend long from all around the world as we are in this sort of new era of what looks like a trade war, but nobody knows.
Right.
And so I think you're right. This is a really good framework to have and a tool that people can look at in addition to everything else. You're going to have your narrative, and importantly, everyone has a different time frame, and I think that's what's really stressful for people.
Right. Yeah,
Some people need that money sooner, and so they're going to have to be making some really, really hard decisions. Hopefully they're talking to their financial advisor over the weekend, but other people have more time. And so all of this is just a really important, I think, tool to be able to, no matter what your narrative is, no matter what your politics are, no matter where you're sitting in the world, have a sort of uniform basis of information to be looking at, right? Everyone's looking at the same chart. Everyone might be feeling different, but everyone's looking at the same chart. So I think this is a really important time for the work that you do. So I'm so excited that we can go ahead and do that. Before we get going, though, I just want to get your sense. What's the biggest concern you're hearing from clients? Like what's your incoming been this week?
Yeah, I mean, listen, that this will be prolonged. I think that's the biggest concern. I think there's always hope that a correction is just that, one of those historical entry points. Well, okay, when the market goes down 10% and you buy, the results tend to look like this, right? So that's the hope that I hear. I think the fear that I'm hearing is that it's prolonged. And that is something, unfortunately, that is indicated by the longer term metrics that we track. We do believe investors, if they have the luxury to be long term and focused, they should be. And we often, and this includes our ETF, we focus on month end closing data to try to eliminate a lot of the noise that we have. Obviously, in our research, we're getting caught up in the short term as well. But on the long-term indicators for the S&P 500, for the NASDAQ 100, we have our first momentum sell signal based on the monthly MACD indicator, a very common technical tool, since the start of the bear cycle in 2022. And these MACDs have been positive for, a long time, a couple of years almost. And with that in mind, we do think it's a meaningful long-term shift. It could mean we're getting into a trading range as opposed to a bear cycle, but there are indications of a bear cycle. And so we want to be respectful of that. When we're talking about looking for any kind of low, short-term low, intermediate-term low, we're pretty clear with our clients to say that this might be an entry point, but it may not have the sustainability that we would want. Typically.
Wow. Okay. That's really important, but really good perspective for us to have. Okay. So, we are both on Substack as well. So we're going to post everywhere where you can find all this information and all Katie's work, at the end, but let's dive in and let's start with the S&P, because I mean, just the numbers we're seeing on the screens are, I think, so alarming. Anybody who's turned on the TV knows that. So let's start there. What are you seeing? And you're going to share your screen and walk us through some of the charts that you include.
Yeah, and I'm happy to. The visuals can certainly really tell this story in a way that we can't do justice to it by just talking about it. So when we look at the S&P 500, and hopefully you can see the screen now. That MACD signal, I'll show that to you because that is like the kind of number one long-term concern that we have right now. And they are widespread. So here's what the monthly bar chart looks like. Now with this swoon, notice that we have this crossover here. That's the sell signal. And the last one being here towards the start of the 2022 bear cycle. Now we are with this sort of cloud that you see here. This is frames the secular trend, and we're seeing this as a secular bull trend, but the beginning of a cyclical down move or trading range at best within that context. And that's important because, again, it adds or assigns probable duration to what we've seen as of Q1, which is a whole lot of volatility, right? Mm-hmm. Downside volatility. And by the way, the upside volatility will probably be there as well. With the downdraft, what we've been looking for when we zoom in on the weekly charts are some kind of reaction to oversold conditions, which you can see here have returned finally on an intermediate term basis. It's a better scenario when you get an oversold reading and you get that right by some support. And unfortunately, as it stands, the S&P 500, as you would imagine, after such a massive swoon over the course of just 2 days, it is below the support levels that we've been watching. So we would have much preferred, of course, to see a reaction to oversold conditions closer to support. There's always a possibility of a shakeout or quick recovery, but we'll evaluate that when that happens. We already have some clients who are interested in buying into weakness, trying to play for that relief rally. It's kind of interesting. I don't have the exact study in front of me, but the biggest up moves actually tend to occur in downtrends. So the biggest up days for the S&P 500. But they're really very difficult to time properly. So it's a pretty dicey exercise. There's definitely investors who are super close to the markets that have that capability. We'll see how it plays out.
And I would say that they often are also people that are skilled enough to use the options market to protect themselves as they're trying to look for that very, very short-term opportunity. When you're talking about being in a larger bull trend, talk to me a little bit more about that, because for those of us who don't follow this all the time, is that some kind of indication that as bad as, and this connects back to your point about, is this something different that's going to be much longer in duration? I think a lot of us are used to, even during COVID, and that there's a sell-off and then there's a V, right? A bounce back. And there's either a Fed put or a Trump put, or, some sort of, the financialization of the economy means that so many people are in the market now that someone's going to support it somewhere.
Yeah,
that's
the hope, right?
Represent that, and where are we worried? Because some of the other downs look very alarming. What are you looking at to try to understand that?
To understand when it ends, right? We will use things like our stochastic oscillator that you see here. Notice that the bear cycle low in 22, we had this is an oversold reading below 20%, and then a retest. That's actually really common, where we get the first oversold and then a retest. In a stronger tape, you'll see maybe a cross up around neutral territory. So that would be, of course, a welcome development, but our sense is that we'll see something worse, just noting that we have that loss of momentum. So the implications from the signals that we have between this MACD crossover, and these are the DeMark indicators that we use, those two signals taken together have implications for about 8 more months. So that takes us, unfortunately, close to year end. That year end that, tends to have positive seasonal influences. So in our mind, we just as a time horizon for this bear cycle or off cycle for the market, we have that sort of end of the year perhaps as where buying opportunity might unfold, boding well for a better 2026, which if you look at our shaded area at the cloud model here, it's flat here, and then it starts to resume that secular uptrend. So that gives us a nice visual indication that 2026 should be a better year for the market. And so with all of this in mind, I think, the messaging is to be reduced in overall equity exposure, or even assign that to risk assets more broadly. Have some cash to put to work, perhaps for those investors who are more traders. They could leverage some of the short-term lows, but also to have some money to put to work closer to year end, perhaps, once we have those indications that a long-term low is in place. And I think that will take some time.
Wow. I am going to go out on a limb and say there are a lot of folks who are not ready to hear 8 months for this downturn, because that's a lot longer than. So let's look at the NASDAQ, because as bad as the S&P was, the NASDAQ has been even worse. And a lot of it is because of the Mag 7 and the fact that, as many have pointed out with me this week, this isn't just about tariffs. This is also about sort of the changing narrative around the AI spend and, concerns about that. So the Mag 7 was under pressure already, and now you have this added tariff and Apple getting destroyed. So what are we looking at for the NASDAQ?
Yeah, I mean, listen, it's very correlated, and that's something that's actually the case. Just in bear cycles or corrections, you tend to see correlations go higher. And that to me is where we start to look at betas a whole lot. So, volatility sort of relative to the S&P 500. And if something were higher beta, you would tend to see it underperform on the downside and outperform on the upside. And that would be assigned to the NASDAQ 100, which you see here has pretty much the same setup on the monthly bar chart. And so this sets the tone for a weaker year. But then also we see a nice resumption of that secular bull trend on the back of this year's sort of setback on the indicators. So we would expect really more of the same. Some ways to derive downside objectives, we use these things called Fibonacci retracement levels. So there are support levels. It's not like the bottom has dropped out. Like, for example, the NASDAQ 100 had this nice breakout at the end of 2023. So that breakout point, 16,765, has the potential to provide long-term support. So that's one sort of threshold that we'd be watching. And then we also like to look at these Fibonacci levels and see stabilization. We often see stabilization around those levels. So we have one basically in play at current levels. So it's not without support. We'd like to see a reaction to that support and a reaction to the intermediate term oversold. But we will expect NASDAQ 100, sort of proxies like triple Qs as an ETF to underperform on the downside. You can see this is a little bit messy looking probably, but this is the ratio of the NASDAQ 100 to the S&P 500. And you see almost a head and shoulders Z top formation. Or just look at the yellow line, which is the 200-day sort of rolling over. And that does suggest, again, that this is going to be a longer-term underperformer, perhaps. This is 2022 that you could refer back to. And what that usually will mean is that technology as a sector is underperforming. Last we checked, the weightings, obviously technology has a very big footprint in the NASDAQ 100. And last we checked, it was comprising about 55 or 60% of the market cap.
Which is why we're seeing so much pain. In this kind of setup, are there, and I'm thinking about the people who maybe need access or have a shorter time horizon, close to retirement, close to needing money for school, close to needing, to be able to put their hands on their cash for whatever reason. Will there be tradable rallies where people can get out, or is the door shut?
I think there will be a tradable rally. I think historically speaking, when you have a VIX spike of this magnitude, it's rarely ever a good time to sell. So I think that should give folks a bit of peace of mind. If they feel like the market's broken, it's never broken and never coming back. I don't think that that's the case. I think we probably will have a better selling opportunity, but that's the mindset that we want to be in, that this S&P 500 swoon, maybe it's the next bounce that we use to either put out hedges or reduce some exposure that's a little higher beta in nature. Because it's a secular uptrend, we don't recommend, going to zero in our equity exposure. So when we say reduce, we mean partially. We're perfectly happy having still core long exposure. I saw a quote from George Soros, I think, and it said, "Good investing is boring." And I kind of love that because, if you can be long-term in focus and be exposed to sectors that have a bit more, safety to them, more defensive qualities, perhaps, sectors that are not high beta, I think that will serve you well to have that core exposure in this environment.
So I think that leads us in. I'm curious. Tell us a little bit about the ETF that you manage, and is that part of the strategy? And I don't want to say your ETF is boring, but it sounds like the cue up that you just gave is that you're thinking about this. I mean, I think we also call it diversified, right? In a way that many of us had become too overweight technology. We're all finding out to our chagrin right now. But talk to me about how you are managing that ETF and why you created it the way you did. And is it meant for a time like this?
Yeah, I'm happy to. So, and this is a pie chart that shows our current positions. This is just representative of the sector spider holdings that we have. And notice we have equal weight positions. So we currently own 7 sector spiders, and 3 of those are very defensive. So we have real estate, consumer staples, utilities, arguably boring. And then one slice of our pie chart here is in alternative asset classes to equity. So we have short-term treasury exposure, long-term treasuries, and gold. And it's that diversified, what we're calling risk-off exposure that can really protect and maybe even be a source of outperformance versus equities in this type of environment, which has certainly been the case. I'll show you the ratio of the gold ETF that we own, which is the gold mini shares, to the S&P 500. And you'll see not just the explosion in relative performance here, but how that's really part of a longer term breakout that favors gold over equities. So it's pretty remarkable. It would just enhance what we're seeing elsewhere. But the fund is a very low beta and low correlation to the S&P 500. So TACK acts as what we see as a very good core holding, just the kind of thing that you can hold through this type of environment. Active ETFs, as you know, are really unique in that they're dynamic, right? They're going to respond to market, ours will respond to long-term momentum shifts. So we would expect that we will move lighter on the equity exposure as we see these monthly indicators start to roll over on a more broad basis on the sector front. We just kicked out technology, as you could imagine, as a sector that had done us very well for a long time. We had owned it since mid-23. So these are shifts that now the ETF can respond to. And what's nice about not just TACK, but ETFs in general, they have a bit of a tax benefit in that, any kind of taxable events can be absorbed through the in-kind trading that the ETFs do. So for someone doing like a sector rotation strategy, they would naturally incur quite a few taxable events typically with that type of strategy.
Yeah, and first of all, I mean, this is we are having a conversation now about active management, and the ability to be react in real time right now. And I think this week is a perfect example of that. It's so hard to catch up when you see this happening, and move the Titanic of passive in this environment. So it's interesting to me because I think a lot of people are trying to figure out. Um, what do I do? And the way this is set up, it's back to your point about not fading equity completely. Because I think in the week we've had, and understandably, people are like, get me out, cash me out, get me out of equities. But you're not doing that with the fund.
No, and we actually still stand at about 87+% equity exposure. Again, we do expect that to go down. In 2022, we saw the fund go to only a 12.5% position in equities, and that was the energy sector, which was really the only source of gains on the sector front in 22 for the most part. So that can happen. We've seen over the course of the model behind our ETF, it went fully risk off, meaning like fully treasuries gold.
Wow.
3 times, only 3 times though, over the course of now 23 years or so. So it's really very rare that the fund itself will move fully out of equities. And that would be only in the very extreme sort of bear market environments, like a 2008 type of environment that could happen. But that's the fund being sort of like a dynamic version of the old 60-40 type of portfolio, right? It's kind of doing it for you and ends up over time looking kind of like a 60-40 ratio of risk on via the equity sectors and risk off via those other asset classes. But at times it'll be like wholly equities when the market is working. Mm-hmm. So it's nice to have the charts on your side when you're trying to rotate in that manner. And so that's what's really cool about, I think, active versus passive. It can respond to the current environment. And passive has obviously had its, sort of heyday in 23 and 24 with the mega cap app performance. But as we know, the market moves in cycles and things change and themes change. So it's nice to have something that's a bit more adaptable.
More adaptable and multi-asset. Yeah, I think a lot of us are thinking about that. And let's talk about gold. Let's zero in on gold for a second. And because I feel like this is, I've been having a lot of conversations with folks who are saying, whether they're money managers or fund managers or macro researchers saying, listen, everyone's kind of underexposed to gold. But it's a tricky market if you're not a commodity trader. So this seems like, am I wrong in thinking that this is one asset area that you're going to be watching that we could see TACK increase exposure to? And so walk us through what you look at as a portfolio manager. How are you going to know if you want to increase your exposure to gold? And what are we seeing with the gold price?
Yeah, so I mean, listen, look at gold, right? This is the monthly chart. And it's not without signs of exhaustion, but it's been managing through any kind of overbought indications very well. And it's because of this, which is the strong upside momentum. You can contrast that in your mind with what we just saw for the S&P 500. So just looking at the histogram, you can see that it has pretty good long-term upside momentum. We're using gold as like a default position to manage risk. So rather than evaluate it from a trend following perspective, we're sort of trusting the historical relative performance of gold, the short-term treasuries, which would be for us about 1 to 3 year, but are closest to cash that we're holding, and then the long-term treasuries as well. The diversified risk-off categories in that way, they tend to, do much better in these types of environments. So that's why we want to build that exposure. The way we'll default to it is basically if we have to kick out one of the equity sectors. And we do that when we see that loss of momentum. That's pretty meaningful. I'll show you an example in the technology spider, which we recently said goodbye to in our positioning. That the tech spider, you can see here, it's a combination of indicators that we're using. But you can see a MACD sell signal. You can see an overbought downturn. You can even just see it in the moving average of price, the 12-month moving average having rolled over. So even if you get a snapback, all of these indicators taken together would suggest that it's probably a better selling opportunity. And those are the things that we're measuring. What else is interesting in this environment, I would say, is considering equal weight versus market cap weighted strategies, I like that in this type of environment, in that over history, like if you were to equal weight individual stocks, like if you took it just one of the passive equal weight indices and invested in that perhaps via an ETF, that actually historically underperforms an equal weight sector exposure. The rationale there would be that by equal weighting the individual stocks, you're assigning a pretty decent weighting to the worst of the worst, right? The worst companies in that benchmark or index. And by investing in the sectors, you're effectively getting this kind of market cap weighted sub the sector, right, on the individual stock level. So you are, when we owned XLK, we knew we had oversized exposure to Apple for one. And we were comfortable with that because the market had rewarded Apple with its market cap. So we think about the idea of trusting the market to reward the good companies with the higher price. But also knowing that there are times, especially when technology is not the source of upside leadership, that you can really benefit from tracking the momentum and relative performance of the other sectors.
Yeah, that's a great point. So you not only are looking at sectors, of course, for the ETF, the fund, but you are also doing technical analysis on them all the time. You have a sort of like dashboard of your sectors. So I think a lot of people are asking in this environment, what's going to do well? Like what's going to work? Are consumer staples going to work? Is people still have to go to the grocery store, even if we're hurtling toward a terrible recession? Or is it something else? Is there anything that looks like it's holding up well? I feel like I don't want to say outperform because everything's down, but that looks better positioned. The technicals look good in terms of holding up through a tough time that we may be in for.
Yeah, and listen, we just have to acknowledge that we're talking about relative performance, right? And we're talking about relative performance
into the unknown, by the way, as well.
Yeah. So we know that even in a like the best relative performer in a weak tape may not be posting great gains. But the way we track this is in part using this, which is a really cool data visualization tool. So I'm going to make it bigger here in a second.
You always have the best charts. I actually feel like I understand them when I look at them, which is saying something.
Yeah. And so this is called a relative rotation graph. And it's from a third party. And it's a great tool to show where the relative performance is coming from and may then subsequently come from. The crosshairs represent the S&P 500, and here's all the sectors with a 6-month trailing history. You can see they tend to maintain this clockwise rotation. If we were to go farther back, I'm guessing you'll see that rotation a little bit more evidently. So here, what is pointing up and to the right? Utilities, real estate, staples, and bringing up the rear are healthcare and energy, maybe materials. Notice what's not. Technology, communication services, these closer to the middle are usually closer to inline performers. But this also would reflect, the loss of momentum and relative performance behind mega caps, because these are the mega cap heavy sectors. So not only tech downside leadership, but mega cap more broadly. So to me, it's these ones that are sort of, they've established upward trajectories, meaning they're outperforming with growing momentum. But we stay with sort of the positions here perhaps as well, financials and selectively within discretionary. And then we would be penalizing technology and communication services because of that weaker trajectory. We can see this full rotation unfold over the course of a year or so. So the hope would be, or the thought would be, that we'll see a reemergence of the former leadership on the back of this, off cycle for equities.
Let's switch gears and talk about treasuries, because you mentioned you're holding short term. I think a lot of people are doing the same, closest as you can get to cash because of the uncertainty. We've seen big moves. We're talking about stocks. We've seen huge moves in the 10-year this week as well.
It's been wild,
and there's a lot of, and we're coming off a strong jobs report. So everyone, I think, the market was racing ahead, sort of factoring in Fed cuts. Now we had a robust jobs report. We'll see. It's probably not catching all of what is about to happen. It might be backward looking. It is backward looking. But I think there's a lot of confusion now for the 10 years. So what are the charts telling us?
Well, so, the yields moved right back into their range. This is 10-year yields on a very long-term basis, looking at the monthly bar chart. And you can see the range defined by resistance just at this previous high. It was around 474, and then longer term support around 378. So we're in this neutral long-term range for yields. Within that context, you've seen downturns. The momentum has been deteriorating, if you want to frame it that way, for yields, going to the downside. And then this downturn suggests that the lower boundary could be tested as part of that sort of weakened momentum scenario behind yields. We would reconcile that with what we think was a secular shift. So if we go way back on yields, and also that the monthly cloud would suggest this, I mean, way, way back, right? You can see how this multi-decade downtrend feels like it's reversed, right? So could we still go into the mid threes or something within that context? Yes, certainly could. But we think that this is the start of a secular uptrend in treasury yields. And so right now, that might not be, an issue with the indicators mostly pointing lower at this time, longer term. But we feel like this will ultimately kind of resume such that yields will make a higher low. It's not a hard call to make with the low being so low, right? Mm-hmm. But probably a higher low somewhere in this area, if not higher.
That's significant, important, and again, not what the market is sort of talking about, looking at right now, thinking the Fed's going to come to the rescue. Let's round it out with the dollar, because this is another area where there's a lot of conversation about whether we've entered a new regime for the US dollar.
Yeah, and as you know, the dollar and yields have a positive correlation. So I'll share the chart there as well, but it has moved into a trading range, or back into a trading range, I should say. And that has, sort of led to downturns as well in those same monthly gauges. So you see a pretty similar setup in a way, back into a range. This actually looked like a breakout for about, a month, and then it just failed. And this is one of our DeMark signals that would suggest that this support, you see it around 102, is the bottom of that cloud. That's a support level for us. Might be in jeopardy of breaking. This also would suggest that too. So we think there's potential for the dollar to continue to weaken, but still within the context of that longer term neutral trading range. And just like yields, it could end up yielding a pretty major low sometime later this year.
Amazing stuff. Katie, I feel stressed but calmer about my stress right now after talking to you. But I do think it's really great even to just get visuals on what's happened. But I think we're in an environment, we've been saying we're trying to separate signal from noise, right? So I think this whole exercise was really helpful. Hopefully people can sit back and look at the work and ask the right questions, right? That's always what we want to do, is figure out like, what do I really need to be paying attention to, and what questions can I ask? So I really appreciate you on this crazy week.
I know it. I'm so glad we could talk. It is good. And it's good to also, contextualize things in a longer term framework, I think, at these times, just to know what we're up against and, position accordingly. And the market, we all know, is cyclical. And unfortunately, sometimes it takes this type of activity to shake off the excesses. So we'll see how it goes.
We're gonna take that Zen thought, through the weekend, but so appreciate it. As I said, Katie is on Substack. You can, and the ticker is TACK for the ETF. You can find her there. She's going to be doing some great work helping keep us on track through all of this crazy volatility. Katie, thank you so much. Of course.
Thank you, Maggie.
Appreciate it. Everybody, it was a long week and it's not over. These are volatile times. So make sure you take a break over the weekend and take care of yourself. Thanks, everybody.